Hey, thank you so much for joining me. This is Mr. Market. We're now to episode 24. As a recap for our portfolio, for the past week, we were up $1,651, putting our year-to-date return to $26,226. As you can see, we have a little bit more work to get back to our old highs. And for our inception to date, since we started the pendulum algo, we are up $65,175 for the past 11 months. As a reminder, our goal is to earn $50,000 a year or 20% off a $250,000 portfolio on an annual basis. Okay, so let's talk about the market. As we all know, the big news of the week was that the US raised the debt ceiling just 3 days before its first ever default. And as you can see, a lot of risk measures started to fall significantly upon the news, with bond yields falling significantly and the credit default swaps falling significantly as well. And as the news came out that it was going to be passed in both the House of Representatives and the Senate, the market celebrated by taking stocks to newer highs for the year. So one interesting thing about the market is that when it is expecting good news, it will rise in anticipation of that good news. So once the news is actually released, I would say well over 90% of it has already been priced into the market. So by the time the good news is out, the majority of the gains have already been earned, and it only leaves just a very small amount for the people who come in last. And what we have right now is a pretty overbought condition in the market. And also, if you take a look at the volatility index, the VIX index, also known as the fear and greed indicator, that one is at all-time lows for the year. And it's very troubling because when the VIX is at a low, that usually means that there's very little fear in the market. And when there's very little fear, that's when investors tend to pile on into the market. And that's what makes the market a little bit more top heavy. As the markets are reaching highs, that's usually a sign of more and more confidence. And time again, we've seen that only after markets have moved up, that's when investors tend to add to their positions in their investment portfolios. So you have this top heavy market, and at the first sign of any trouble, that's when all the investors are kind of tripping over themselves to get out and sell. And that's partially why there's that saying that the stock market takes the stairs up on the way up, but it also takes the elevator on the way down, meaning that it has a slower rate of increase on the way up, but a much faster rate of decrease on the way down. And one effect of having lower volatility is that it also reduces the option premiums that we get from selling our contracts. So we're not immune to this effect either. When the volatility is lower, we have to sell either more contracts and therefore increase our position size and our risk, or we also need to increase the duration of our options contracts. Now, typically we only sell weekly options, but when volatility is low, in order to earn more premium, sometimes we have to go beyond a week, and that can also increase your risk. So there's really no good way to deal with this other than to either increase your position size or increase your duration if you're trying to earn a constant rate of return. So for us, if we're trying to earn $50,000 a year, we need to go sell more contracts in a lower volatility environment like what we have today. And because of this added risk, it becomes even more important to respect the trends and pay extra attention to when that trend actually breaks. For now, the algo is pretty positive, so we're going to continue to ride this trend. But once that trend breaks, we need to be extra vigilant in shrinking those positions when we have to. So another piece of news that caused the market to go up was that the Federal Reserve officials who spoke recently suggested that they wanted to pause the pace of interest rate increases. And so they're inclined to skip an interest rate hike for the month of June so they could have a little bit more time to let the past interest rate increases work its way through the economy to see how much the economy is actually going to slow. But as we've seen with the recent jobs numbers, the economy created 339,000 jobs in the month of May. And even though we've seen indications that inflation is falling, when you have a really tight labor market And when you have other economic indicators showing this kind of strength, it is increasing the expectation that after this pause in June, that the Fed may raise rates again one more time in the following month in July. One interesting side effect of these interest rate increases is that investors have been conditioned to flock towards the largest and safest stocks. Because if there's going to be a recession, these types of companies, these large cap companies, tend to hold up the best when markets are falling. And so we've seen a big inflow into these large company stocks and a big outflow from the smaller and mid-sized companies. And one effect that has come from that is that now we have a really outsized concentrations in just a handful of stocks that drive the entire index's returns. So recently, it was shown that Apple's entire market cap now exceeds that of the entire Russell 2000 small cap index. As for the NASDAQ, 50% of its entire weight is just made up of 7 stocks. And the Russell 1000 index no longer fits the definition of being a diversified index because such a large concentration of it is in a handful of names. To add to that, 90% of the S&P 500 index's returns year to date have only come from 6 stocks. And if you take a look at the AI stocks, if you take that out, then the majority of the S&P 500's returns are gone. So this is starting to get to be a bit of a problem, but as long as the market's continuing to go higher, I don't think you'll see a lot of people complaining too much. So what can you do about this kind of problem? Well, one approach is to own the equal weighted S&P 500 ETF, symbol RSP. And one downside to that is that if you don't have as large of a representation in the most successful names, you're going to have some pretty subpar performance. And year to date, RSP is only up 1.5%, whereas the market cap weighted ETF is up 12%. So, this is a situation where being diversified is actually hurting your performance, and it's going to create a little bit of a feedback loop from investors because they want to pile onto their winners while they're trying to avoid the losers. One other thing we can do is to start taking a look at international stocks. This is something that has been neglected for many, many years. If you take a look at the relative performance of the international stocks to the US stock market, it has underperformed for over a decade. But if you take a closer look at how international stocks have performed recently, you can see that it broke out of its over decade-long downtrend. And so there's something really interesting going on over here, and a lot of people need to go pay more attention to this because largely these international stocks have been ignored. And now it's starting to make a little bit more sense to start reintroducing our exposure to international stocks. On a valuation basis, international stocks are much cheaper than US stocks. And because of this lower valuation and because of these improving trends, Vanguard has even put out a report that shows that they are expecting higher returns from international stocks than US stocks over the coming decade. So now that the debt ceiling issue is resolved, there's really not that many factors that can really derail this market. The one thing that would be overly tight monetary policy, meaning interest rates going up further than the market is expecting, which could tip the economy into a recession. Now, right now, the expectation is that we'll only have a mild recession. And with the Fed pretty much hinting that they're going to pause under interest rate increases for the month of June, that kind of gives a little bit more runway for this party to continue. But we also need to remember that also now that the debt ceiling has been raised, the government is going to need to sell billions and billions of dollars of debt in order to go pay their bills. And when they're flooding the market with that debt, guess where all that money is going to be coming from? It's going to be coming from investors who are going to be buying up that debt, and that's going to siphon away some of the investment money in stocks, and that part could provide a little bit of a headwind for the market. But other than that, there's still this strong momentum and this breaking out to new highs that we need to respect. And so we need to keep riding this for as long as the party continues, only as long as the trend is continuing to be positive. But once that starts to break, then we need to shrink our positions and be very, very careful because again, the stock market is a little bit top heavy, and if we start to see some losses, that selling can cascade and cause the markets to fall a lot faster than it's gone up. So for my portfolio this week, I sold some puts at the $420 strike price and $415 strike price. And also because we've been pretty extended on the market and because the VIX has gone down to such low levels, I decided to do a little bit of an experiment and sell some calls, some longer dated calls that expire at the end of June. And I sold those at the $450 strike price just to give myself a little bit of a hedge. And I sold some puts on the bank ETF symbol KRE at the $39 strike price because it just recently closed above its 50-day average, which was the first time since the banking crisis started. So, I think there's going to be a major shift in sentiment now that things are starting to go stabilize, and I'm starting to nibble on this again now that the trends are a little bit more positive. And as I mentioned earlier, since the international stocks were finally breaking out of its long-term downtrend relative to the US market, I started to go sell some puts on the international ETF, symbol EFA, at the $70 strike price. So that's all I've got for this week. Thank you so much for joining me. And if you haven't yet, please click like and subscribe so then you'll know when my next videos drop. You can find me on my new domains at mistermarket.us or mrmarket.us. So thanks again for watching, and I will see you next week.